Good Saturday morning to you, and welcome to On the Mark, along with Mark Papa. I am Gary Byron. You can check out Mark at his Glastonbury office over in Glastonbury, and then online at www.frplan.com. It's great to see you, Mark. How have you been?
Oh, it's good. Good to be back.
It's great to have you.
Good to be here.
How was your... Oh, by the way, today, first full day of spring.
I know. That's exciting. In fact, it's been nice to see the daylight savings turnover and, being at the gym and it's, 4:30 at night and it's not dark. So it's much more, it's a more positive, more energy, it's just a more positive way to end the day than, going to the gym and having a long day and you're sitting at work all day in the sunlight, and then you get out, and it's dark. It's just awful.
I was talking to someone, I don't think it was this, it might have been 2 weeks ago. Seasonal depression is a real thing, by the way.
Yeah, I couldn't agree more.
Because it's dark and cold, and it just leaves, like all the time. Like you just said, you go to work, it's dark, get out of work, it's dark.
It's a tough winter. I can just even tell at the gym, and just people in general seem to be a little bit more uppity and a little bit happier now that the weather's, it's starting to break. So that's good stuff.
It is. We need that. We need more of that. Let's start at the top. Give people a big picture view of where global stock markets stand right now. As of today, it's the 21st of March, 2026. What's the headline story?
All right. Well, first off, I'd like to say this radio interview is obviously informational and for educational purposes only and does not constitute investment advice. Financial Resources Group, LLC, is a registered investment advisor. Past performance is not indicative of future results, and all investment strategies involve risk, including the potential of loss of principal. Listeners should consult a qualified financial advisor before making an investment decision. Let's get going. Gary, it is we're living in historic times right now, interesting times.
Yeah, we are.
I think, front and center is what's happening in Iran. You have issues with, the job market. You have issues with the potential for inflation is elevated oil prices due to the, Iran, we can call it a conflict, going to bleed through to the economy. And I think the big picture here is when do they finally open up the Straight of Hormuz to get to start getting that oil to start ship safely again. And I think that's the big thing, the big cloud over the market right now. And there's several others, so we'll get into that. But I think that's the big cloud over the market right now is when does the Strait of Hormuz be a place that, crude oil can flow through safely. And I know there's other channels that are being, attempted to be opened up. They took the sanctions off of Russian oil. We have U.S. oil. But, there's a huge amount of, millions and millions, hundreds of millions of barrels that flow out of the Strait of Hormuz. So we definitely have to get that opened up. And I know that they're working on that. But to date, I haven't heard much more. I think once that cloud lifts, the market's gonna be happy.
Well, the question is, when will the cloud lift?
No one knows.
We don't know.
You don't know. That's why we diversify. Right?
Are you happy so far with Trump's job in office? Or?
Well, I would say the whole approach. Let's take a look at the big picture of what's really happened. It started in Venezuela, and what was Venezuela doing? Venezuela and the Russians, they were subsidizing Venezuela. They were subsidizing Cuba. Right now, Cuba went dark. They don't have any electricity. I think from that perspective, Trump was trying to protect our hemisphere, right? Strengthen our hemisphere, get rid of the bad actors. And these bad actors, like Venezuela, own a lot of oil. And I think what they were doing there is they got Maduro out of power. They're taking over the oil so that now Cuba's got to come to the table and chat with us. Now, if you look at the Iran situation, the Chinese have been buying oil from the Iranians and it's sanctioned oil at a very, very steep discount, about $20 a barrel. And the Iranians are moving, 100, I think it's like, something like, I've heard stats as much as 90% of the oil that China imports is from Iran. So you cut that off. And now you have a means to negotiate with the Chinese because at the end of the day, they're not going to be able to refine, from what I'm hearing, and I have no proof of this, they cannot refine oil profitably unless they get that discount. So there's been a lot of shenanigans going on in the world that aren't being talked about, and this is a very, very strategic move as to what Trump is doing, and he gave, I think, the Iranians a lot of room to come to the table, and I also think there's a lot of misinformation and lies being spread. So you have to be careful of what sources you're listening to, and if it's a political source, obviously, we're killing children and grandmas, but at the end of the day, I think big picture, this is a very long-term strategic move that whether you love Trump or hate him, I think will be a good thing. If we can be victorious in Iran, they are the world's largest sponsor of terrorism, bar none. And I think if we can get this under control and get the Iranians under control and get that situation to where, they're not the leading sponsor of terror in the world, and because they are, then we'll be fine. I think that's going to make for a much better world in the future. And I think there's a lot of Americans willing to make that sacrifice, and we'll see what happens,
How does that affect the S&P?
Well, it depends. I mean, in the short run, the markets don't like uncertainty. In the long run, and I think it's going to be very positive because we have a safer and better world. So,
okay, so it'll have I guess it comes down to how patient someone is. Everybody wants immediate fixes, right?
Yeah, no, a country like Iran is, you can't just. I mean, I think they've been decimated, but at the same time, even today, I heard a story that they want to start. Create a toll booth in the Straight of Hormuz, and I don't even think they have anywhere near the capability to do that anymore. I think it's only a matter of time before the regime is going to collapse, the people are going to rise up, and it's going to be over. So we'll see.
I know that you follow the equal weight version of the S&P 500 closely. So what's happening there? I mean, and can you explain to people why equal weight even matters?
It is a very big deal, Gary. I think since I've been on the show, I've been harping about, if you just buy the S&P index fund, then you own mostly the Magnificent Seven stocks.
Right.
That game has changed. So that game has changed. It's the hyper, super hyperscalers of the Metas and the Facebook, the Facebooks, the Amazons, the people building out these giant data centers. There was they got essentially the market is asking to see some profitability there. Show us what's your end game, and they're putting 750 billion roughly dollars into these data centers. So what we're seeing is that the market got repriced, the market got revalued. We've seen disruption in software stocks. Market was revalued due to Anthropic and Claude. So we've seen a big revaluation, but we've seen as a sector rotation out of the Mag 7 into other sectors in the market, consumer discretionary, defensive, and other areas. That's been a very big positive. But we were positioned for that because we were in a more equal weighted strategy. We were in a quality factor strategy, which we're going to talk about today. We're in equal weight. That's our ROE, which is equal weight, as more of an equal weighted approach, meaning equal weight means that if you have 30 companies, each one is going to get roughly the same amount of weight. The Dow is equally weighted, but the S&P was market cap weighted. And I am a big disbeliever that market cap weighting is the way to go if you're retired. Now, if you're 22 and you just want, grandpa sets up a Roth for you and you want to throw it in the S&P 500 and let it ride in dollar cost average for the rest of your life until you retire, you're fine. The problem becomes, can you accept a 20% drawdown when you're retired? And that's happened, numerous times. The problem is, Gary, if I'm adjusting the S&P and everyone says, well, that's what Buffett says he's buying for his widow. That's great. That's Buffett. Buffett's worth, hundreds, 50 billion. You're not worth 50 billion. The other problem with that entire story is Buffett's not invested in the S&P either. He has individual stocks. So, a lot of people use that as a way to say, well, I don't need an advisor, or, I can just do it on my own. And then the other side of the equation is some of the big firms are actually charging people a lot of money in these index strategies to buy, 200 or 300 stocks in their account that mirror the S&P, so they can charge a fee of 1.25 to 1.5% on their money, which makes zero sense to me. They're just trying to cherry pick. So if you're going to buy the S&P and you want to be market cap weighted and you have the stomach for the volatility, fine. However, and we're going to talk about this today and in my next segment, the bottom line here is if you can't tolerate in a 20% down market, Gary, if you need to take your 5% out, now you're down 25, right? Let's say you need to take your 5% out for the year to live on. Mm-hmm. Now you're down 25. Guess how much it takes to get back to break even when you do that?
How many months?
No, just what percentage? I'm sorry, my apology. Let me be more clear. What's the percentage gain if you're down? So you're down 20, you took your 5 out, now you're minus 25 in your account. You need to make 33% just to get back to ground even, Gary.
Oh, really?
Yeah. So that's a big, and then that means next year you need to take out your 5% again. Can you do that? So my whole idea, what we've been doing successfully is managing that volatility and managing that risk, not with market cap weighted indexes, but using other strategies that we call factors in other ways of, equally weighted or quality factors, or, there's a profitability, there's size, which is, big minus small. So and being truly diversified. Owning 300 stocks doesn't mean you're diversified. What it means diversified is you were in large, medium, small, international, small. You have a good variety: oil, real estate, gold and silver. You have to have that mix. If you don't have that mix, you're really not diversified.
You personally prefer the equal weight approach with your clients. I know this, and it sounds like this year is really is really vindicating that preference. But what's the long-term case?
Well, the long-term case is up until recently, again, this Mag 7 dominance, equally weighted, has done significantly better over, I can't quote the time frames, but I know Morgan Stanley had an equal weighted S&P fund, and it would trounce the S&P every year, for whatever reason. And the reason why is I think it just goes down where those companies that are growing or climbing the ladder very fast, you get a little bit more of those. Mm-hmm. So we don't do exactly on our S&P strategy equal weight. We do an earnings weighted version. So like the companies that are earning the most and consistently making their quarterly earnings, which again, the SEC is looking to possibly eliminate. But the companies that are earning the best and are most consistent in their earnings strategy get a little bit bigger piece, but not a giant slice like the ones that are, in the cap weighted index. So we get a smoother ride, and we're going deeper into the index and finding companies that deserve to be rewarded that get ignored when they're in the main S&P that's cap weighted. So by equally weighting or fundamentally weighting, you get a much better, I think, long-term outcome, in my opinion.
Well, you've mentioned dividend stocks and and defensive sectors. They're coming back into favor. So what are you seeing here?
Well, the defensive stocks, these are companies like they've been ignored. I mean, everything's been ignored over the last, up until this transition began in 2025, where these companies that are just with these fortress balance sheets, people started questioning what was going on with the data centers. So obviously, what's happened is you're starting to see people say, hey, wait a minute, let's take our profits here, and then let's start spreading our bets around again. So we're seeing more participation in other sectors of the market versus just those main big technology companies. Big tech dominated the market since 2023, basically, right? Okay. I mean, in 2022, tech was terrible. It was down 30% in the NASDAQ, but then it came back. And then 2023, in my opinion, and I think we should have had a recession in 2023. And instead, they spent like crazy. They went and doubled down on the COVID and, spent like crazy. They knew the election was coming, and that propped up the market. But the one thing that kept the market going was ChatGPT. You hadn't heard anything before. I said this in a previous episode. You hadn't heard of the Sam Altman or ChatGPT prior to 2023. No one, unless you were in Silicon Valley, no one even knew who this guy was. And then all of a sudden, Microsoft invested in them. And here you go, and Microsoft started going crazy. They're one of the largest components of the S&P, and that carried the whole market that year.
Well, then you got Grok, right? And then there's some other AI platforms.
But they didn't have anywhere near the impact. That's because Musk went and bought Twitter, and then he created Grok, and now Grok just got bought out by SpaceX. It's another $250 billion valuation.
It's another Elon Musk company, though.
Yeah, they're a combined entity, and now we actually have put our clients, or some of our clients, we put it out there, had the ability to access the SpaceX IPO and several other of these unicorns that when I call unicorns, these are private companies. Companies are staying private for like 15 to 20 years before going public. So what that does is that makes it harder and harder to get good quality small cap companies because these companies are just blowing up and going, they're waiting forever to go public. So it's a really interesting market.
Tell me about the great rotation. I know that this is a short-term phenomenon. I know it's driven by tech weakness. But is there something more structural happening with it?
That's a good question. I think people are just looking to find places to put their money that, areas that are undervalued and, areas that are long-term in nature. Yeah, I don't think that's really what it is. I mean, you can't everyone can't own the same stocks forever. So I think it's, in a way, when the market gets volatile like this, it becomes more of a stock picker's market and it's more of an investor's market. And indexing has been so popular where, passive indexing can just put your money in the index, and it's been programmed to do that, which is a good thing, I think, for most people because versus a mutual fund. Mutual funds tend to be more expensive than an index fund. So, and they're less tax efficient than an index fund. So it makes lots of sense for most people. But yeah, I don't really think, I really think that this rotation will happen, and then those stocks will become overvalued and people rotate out of those into some other areas that are undervalued.
So at Financial Resources Group, do you think this rotation has legs?
Oh yeah, I think it's probably about a 3 to 5 year trend from this point forward. There's no question. I mean, the value-oriented names, they've been left behind for so long, and eventually, what happens is you own a value stock, and eventually, what happens is people and investors and institutional investors, pension funds, hedge funds, whatever, they eventually realize, hey, this is a great company. It's got a strong balance sheet. It's got good earnings. Yeah, gee, it's only trading at a historical low of its multiple of maybe like, let's say 8 times earnings when it should be trading at 12 times earnings. And if I just be patient and hold my, and do my math, the stock is worth 50% more than what it's on paper today. So let me hold it and be patient. And value investors are patient investors. And value over long periods of time does very, very well. Again, in most more recent times, if you look at what beat the market from 2002 to 2007, it was value stocks that crushed everything. No one wanted to touch the NASDAQ because everyone was so beat up after the dot-com bubble and after the that crash. People were so beat up, they didn't want to look at technology. Technology was like a bad word. And then all of a sudden, it took the NASDAQ, it took 15 years from its peak to actually break even again.
Folks, you're listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark is with Financial Resources Group. That's his company. It's based out of Glastonbury, Connecticut. Of course, you can always look them up online at www.frplan.com. Mark, what's your phone number?
860-657-8380.
That's simple. 860-657-8380. I'll give you all those. I'll repeat that more towards the end of the show. Mark, go ahead.
Before we go, I don't want to forget the fact that last year it was global stocks. It was, again, they were the forgotten companies in the MSCI, what's called the MSCI index, MSCI index or MSCI AQUI. It's an index for the international index. And those stocks, and then emerging markets as well, did very, very well. So they significantly better than the actual U.S. market because they were so undervalued, and people wanted to diversify away from that concentration risk. Again, we've been pounding the table on diversifying away from that concentration risk for a long time. So what's happened in last year, and I won't quote the number, but we did beat the S&P. We're very, very happy about that. This year, we are trending, again, well above the S&P because the S&P is negative, and also above the equally weighted S&P. We're trending ahead of them as well. As a result of, again, being positioned, being diversified, not taking big bets, not trying to be heroes, but building a good, rock-solid, quality portfolio that I feel is I would kind of say is what they call global macro and global portfolio. But also, I think it's similar to like Ray Dalio at Bridgewater. It's similar to like an all-weather kind of portfolio. It can handle we set it up to handle anything.
Look,
I'm not Ray Dalio, by the way, but
no, I know.
But
you're not insinuating that either.
But at the same time, that's how we do things. We're not making big bets. We're not making sector bets. We're there just to build a good quality portfolio. We look at the data, look at the numbers, we stress test it, and say, what can this handle? And here we have a global oil shock, but yes, we have a good 5% of our portfolio was in global energy, so we didn't get hurt. It actually helped us.
Everybody knows that you're very disciplined. I'll give it to you like that. Knowing you, I know your factor-based approach to building portfolios. All right. So that all being said, walk us through right now the 5 factors that you look for when selecting investments, and tell us why that's working particularly well in this kind of market environment.
Okay. So some of the sponsors we work with are big fans of this. So the reason I was so excited about this goes back to 2006 when I saw this company, Wisdom Tree. And they talked about dividend weighting and earned weighting indexes. And I asked them, says, what kind of factors are you guys invested in? And they said, well, because we're waiting on dividends and we're waiting on earnings, what ends up happening is we end up picking up those factors automatically because you can't fake a dividend and you can't fake an earnings. So these companies can't fool anybody. You can't fool anybody on the balance sheet because it's either you earn the money or you don't. You have the free cash flow to pay the dividend or you don't. So it squeezes out all these bad actors out of your index, which is great. So that's one. That was Dr. Jeremy Siegel in the groups at Wisdom Tree. Not exclusively him, but that's some of his study. But the big deal is that the framework here is rooted in decades of academic research, most notably the work of Eugene Fama and Kenneth French, who won the Nobel Prize for their research on factor investing. And there's so many others out there, but we've refined and extended it at Financial Resources based on what we see working in practice. And the 5 factors we emphasize are value, size, profitability, in quality, investment in quality. So it's size, value, profitability, quality, and also momentum is another one that we use. So we have in our mid-cap strategies a momentum strategy. And that's done very, very well for us also. But, we can walk through these very briefly.
Yeah, please do. I've got 5 minutes before the show's over. So
okay. So our value stocks are stocks that I mentioned earlier that are cheap relative to their fundamentals. These are companies that have historically outperformed expensive growth stocks over long time horizons. We're not looking for quick bucks. This is Warren Buffett. Okay, Warren Buffett owns value. He's a big-time value investor. Benjamin Graham was his idol, and Benjamin Graham is the godfather. And, Benjamin Graham and Dodd, they're the godfathers of value. Brilliant people. And I was lucky enough to catch one of his literally an old class from the 50s. And it felt like he could have given that class today. It was just insane.
Wow.
Yeah.
Would you find it online? Or?
Yeah, it was online. He was a Columbia University professor. But so that's value. Then you have smaller companies. So you have small. And when you go small, but you go value. And small value is smaller companies within, these are small cap companies that tend to, tend to be high quality, good balance sheets that are growing, but they tend to be value. That means they're trading well below what their true value is. And small cap value as an asset class has been one of the best performing asset classes of all the asset classes combined. You can pick any one. The third is profitability. And I think profitability is huge because, being genuinely profitable and being able to generate cash flow is not hype, as I mentioned earlier. And the French Fama research also was very, very clear that high profitable companies deliver superior long-term returns. So you want high profitability, you want high return on equity, you want low cost, and these are the companies that when they figure that out, they tend to become the big winners of the long term. So that's what we like there. The others are companies are quality is one more time. I love quality because it combines management, that combines balance sheets, that combines earnings, it combines everything. And quality means different things. So in our portfolio, one of our sponsors, Astoria Advisors, John Davi, he was just on CNBC, I think yesterday. He helps construct these portfolios that it's quality, but he has a quality for each sector of the market in that product. So it's not quality is not the same for an industrial company versus a technology company or versus a consumer staples company. Quality means something different. So he tweaks it, and we build that in that one index, and it's just really amazing stuff that that we're able to put together and offer regular investors. And these are strategies that typically were, again, there's a big democratization going on in our industry. And these are products that we're able to deliver to your retail client that normally again, all born out of institutional strategies that we use that pension funds, hedge funds, sovereign wealth funds, family offices are now can be, given down to, generated down to our level, basically.
Well, we're in a post-Magnificent Seven dominance, right? With rising inflation risks, and you've got to be disciplined in your approach right now.
Yeah, and I think, those stocks are going to come back eventually. I'm very, very confident in Microsoft. There was a great article that Microsoft is extremely well positioned. They were an early investor in ChatGPT. Their investment alone in ChatGPT is worth a whole lot. And the valuation of Microsoft and some of these technology companies have come way, way down. Hence, the S&P's 500's valuations come down as a result. So, there's going to be some opportunities to bargain hunt. And I would say Microsoft's probably one of those companies, but I'm not, again, officially recommending that. Please call me and ask a professional.
Well, speaking of which,
I think Microsoft's a rock solid company.
All right. Well, let's wrap things up. We got a lot to. Well, this is going to be a two-parter. Join us next week. We're going to continue this very same conversation. In the meantime, you can check out Mark over at Financial Resources Group. They're located in Glastonbury. You can find them online at www.frplan, F as in financial, R as in resources, and call them 860-657-8380. Schedule your no obligation consultation. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark with the Financial Resources Group out of Glastonbury, Connecticut. Until next Saturday morning, have a good one, everybody. So long.